You walk into the market and you realize that your entire budget for the week is about to be shattered.
Right.
Why? Because the price of a simple basket of tomatoes just jumped from €1,200 to 2,000 in like 7 days. Or maybe you're in London wondering why your morning coffee is suddenly so much more expensive.
And these price changes, they can feel so arbitrary, like someone just hit a number generator. But they're not random at all.
Not at all.
They are the market talking to you. They're signals being set by these fundamental forces that are constantly pushing and pulling on value.
And that's exactly the mystery we're solving today. We are going straight to the bedrock of economics, the theory of demand and supply.
Yeah.
This is really the deep dive on how markets communicate and, more importantly, how every single price you see is actually born.
It's the shortcut. If you want to understand inflation or figure out a new government policy or just anticipate what's coming next, this is it. This interaction between buyers and sellers is the operating manual for the entire economy.
Okay, let's unpack this. We should start with the buyer side, with demand.
Makes sense.
We use that word demand so casually. But in economics, it's very specific. It's not just wanting something. It's about how much of a good people are willing and able to buy at different prices.
And that phrase, willing and able, and that's the whole game right there. It's the gatekeeper.
Willing and able?
Exactly. Willing is the desire, the want, the preference. But able, well, that's the budget. That's the reality check. You might want a private jet, but if you can't afford it, you aren't part of the economic demand for one.
And that combination of desire and ability, that leads us right to the law of demand.
It does. The law of demand just states this inverse relationship. It says that when the price of an item falls, people buy more of it. And when the price rises, people buy less.
All other things being equal.
Yes, that's the crucial caveat. All other things being equal.
It makes complete sense. Think about suya. If the price of a stick drops, suddenly everyone can afford an extra one, maybe two, demand shoots up.
Right. And graphically, that's why the demand curve always slopes downward. As the price goes down, the quantity people demand goes up.
We saw a perfect local example with data bundles in Nigeria, didn't we?
Oh, absolutely. When the cost of data came down, people didn't just use the same amount. They started streaming more, chatting more. That lower price unlocked this massive amount of latent demand that was just sitting there.
So that shows how price moves people along the curve. But here's where it gets really interesting, I think. What happens when something other than price makes us change our minds? Let's talk about the demand shifters.
Yes. These are the external forces that shift the entire curve, left or right. They change how much people want to buy. Even if the price doesn't change by a single naira, there are 5 big ones.
Okay, let's run through them. This is the real world stuff.
First up is income. Pretty straightforward. When people earn more, they generally buy more of, well, most things.
Most things.
Most things. We call them normal goods, better coffee, a new car, things you buy more of when you're wealthier. But there's an exception. Inferior goods. These are things you buy less of as your income goes up because you trade up to something better. Think maybe generic brands at the supermarket.
Ah, okay. So if you get a raise, you might stop buying the store brand soap and switch to the premium one.
Exactly. So a rise in income can actually decrease the demand for that generic brand. It's a key distinction for understanding who wins and who loses when an economy grows.
That's a great point. A rising tide doesn't lift all ships. So what's next?
Taste and preference. This one is all about trends. Think about the huge shift from cable TV to streaming services. The price of cable didn't necessarily change that much at first, but people's preference for it evaporated.
Next up is the price of related goods. This one feels a little more complex.
It just means that markets are connected. We split them into 2 types. Substitutes and complements.
Okay.
Substitutes are things that can replace each other. Rice and yam, for example. If the price of rice suddenly skyrockets, what happens?
People buy more yam.
People buy more yam. The demand for yam increases, shifting its whole curve to the right, even though the price of yam didn't change.
And complements.
They're goods you use together. Bread and butter is the classic example. So if a new tax makes bread incredibly expensive, the demand for butter might actually drop.
Because fewer people are buying bread to put it on.
Precisely. The last 2 shifters are pretty direct. Population, more people, more buyers, more demand, and expectations.
Oh, this one is huge.
It is. If you hear that the price of fuel is going up next week, what do?
You fill up your tank today. Everyone does.
And that anticipation creates a massive, instant surge in demand. The entire curve shifts right overnight.
Okay, we've nailed down the buyer. But all this wanting and choosing only matters if someone is actually there to sell the product. Let's flip this. Let's talk about supply.
Right. Supply is the other half of the equation. It's the quantity of a good that producers are willing and able to sell at various prices. And it's all driven by the profit motive.
Which gives us the law of supply. A direct relationship this time. Price goes up, sellers want to sell more. Price goes down, they pull back.
Exactly. The supply curve, unlike demand, slopes upward. A higher price means more potential profit, which is the ultimate incentive to bring more goods to the market.
The gr8t market is a perfect example here. If gr8t is suddenly selling for €2,000 per paint, every farmer with some stored away rushes it to the market.
They do, and others start producing it faster. But if that price collapses to, say, 800, many sellers will just stop. It's not worth their time. They'll wait for a better price.
But wait a minute. Sellers are motivated by profit, so why don't we see supply jump immediately for everything when a price becomes astronomical? Think about specialized electronics or even some crops.
That's a fantastic question. It doesn't challenge the law, but it complicates it. The reality is there's a time lag. A gr8t farmer can bring existing inventory to market, sure, but they can't grow a new crop overnight. A company can't build a new factory in a week.
So there's a limit to how fast they can respond.
Yes, and that idea, how quickly supply can react to price, that actually leads us straight into our next deep dive on elasticity. But for now, let's bring these two forces together. Where does the buyer meet the seller?
Where the magic happens.
They meet at equilibrium. It's the market's sweet spot. It's the one single price where the quantity that buyers want is exactly equal to the quantity that sellers are offering.
The market clears. No leftovers, no one going home empty-handed.
Exactly. Buyers are happy, sellers are happy. There's no pressure for the price to change.
But what happens when the price is wrong? What if it's set too high?
Then the invisible hand starts to push. Let's use sachet water. If a seller prices it too high, say 200 in bag, very few people will buy it. At the end of the day, the seller is stuck with a huge surplus.
Leftover water.
And that inventory costs them money. So what do? They have to drop the price to get rid of it. That pushes the price back down toward equilibrium.
And if the price is too low, maybe just 50.
Then you get a rush. The water vanishes instantly, you have a shortage, and the seller sees the long queues and thinks, wait a minute, I could have charged more. So they raise the price.
Pulling it back up toward equilibrium, it's like a self-correcting system.
It's a constant balancing act. This dance between surplus and shortage is how the market naturally finds the right price.
This brings us to the most important question, I think. We've talked about moving along the curve. What happens when those shifters we mentioned earlier actually move the entire curve?
That's when you see major economic change. The whole market structure resets to find a new equilibrium price. An increase in demand or supply shifts the curve right. A decrease shifts it left.
Let's use a big recent example. The removal of a major fuel subsidy. How does that play out here?
That is a classic textbook example of a supply decrease. When that subsidy goes away, the cost of production, transport, energy, everything, it skyrockets for nearly every producer in the country.
From the person selling water to the textile factory?
Every single one. And because it costs more to make and sell everything, the supply curve for most goods shifts dramatically to the left.
And demand for those goods hasn't changed overnight. So the new meeting point, the new equilibrium, has to be at a much higher price.
A much higher price and a lower quantity of goods sold. And the key insight there is that supply shocks like that often cause way more inflation than simple demand changes, because the cost increase hits every single sector at once.
Let's flip that. What about a positive supply shift, like new technology?
Right. If a new technology makes producing smartphones, say, cheaper and faster, the cost for the producer drops. Supply increases, which shifts the curve to the right.
And with demand staying roughly the same, the new equilibrium price will be lower.
Substantially lower. A huge benefit for consumers.
So if we step back, why should you, the listener, care about these lines crossing on a graph?
Because these forces explain so much. When a government tries to set a price ceiling on bread, they are fighting against equilibrium, which is why you often get shortages. When you hear about a bumper harvest for corn,
you can predict that food prices are about to fall because supply is shifting, right?
Exactly. It allows you to look at any economic headline and instantly understand the pressure it's putting on price. This is the invisible hand guiding what we all pay, sell, and earn. It helps you make smarter choices.
So a final quick recap. Demand is what buyers want and can afford.
Supply is what sellers can produce and offer.
And prices will always move until demand equals supply, that point of equilibrium.
And remember, it's those external factors, income, technology, policy, that shift the whole game, creating a new equilibrium, a new price for everything.
It's a constant, dynamic conversation.
Always moving. But we've hinted at something here. Not all products react the same way to a price change. Sometimes a huge price hike barely makes a dent in how much people buy.
And that leaves a final thought for you to consider. We know prices change, but how sensitive are people to those changes? Why does the demand for an essential like fuel barely move when the price soars, but the demand for a new fashion trend can just vanish if the price ticks up slightly?
Stay tuned for our next deep dive. We'll be measuring that exact sensitivity. We're going to explore the crucial concept of elasticity and how knowing that number can tell you exactly where the market's true power lies.